Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, take you off course, help to make it actionable, understandable, and clear. It's another week. Therefore, it's another show. 3 excellent articles we're going to be talking about. Give you a little window into what's going on in my mind. We're going to be looking at the CFP board, Certified Financial Planner Board, CFP being the most popular designation amongst, I believe it's most popular amongst financial advisors. We then look at a Wall Street Journal article about the AI chip boom. Doubtless you've heard NVIDIA and others, how valuable they've become. I'm going to give a little window into why I think it should illuminate our understanding of index investing. And then we end with a little Howard Marks talk, the venerable Oak Tree Capital investor. At the top, though, let's talk about the CFP board. So financial advisors can have a number of designations. They're multitudinal. I don't want to say they're 20, maybe 15, maybe 30, all varying importance. It's my opinion that the CFP is probably the most important for financial advisors. And when I say important, I just the most probably respected and understood and well known. There was a season where there were just no designations that financial advisors could really hang their hat on, and increasingly the CFP has come to the fore as one of the main designations that people look for. And it's a really, I'd say it's an excellent educational program. The CFP, what they do is they put applicants through a robust set of domains that when you have domain expertise in, and then what they aspire to do is the CFP designation could be a trusted designation, so that if you're looking for a financial advisor and you say, oh, where should I go? Oh, great, this person's a CFP. That means, hey, they won't hose me, or it'll be safe, or it'll be good, and all that. So my view is that they actually do a great job on the educational side. I don't see the protection of the customer where I would like it, and I'll explain why. So I was reading something that caught my eye, and this happens a lot when I cross CFPs. I am not one. This view on index funds versus active funds with CFPs, there's not a high level answer from them. There's not a word from Mount Sinai that comes down and says, thus you shall invest. This is the best way to do it, which I always found a bit perplexing. Additionally, there is not a strong view on, hey, are people, if you have a CFP designation, you should not be selling products on commission. There is a standard for disclosure whereby you have to tell people you're making a commission. Here's where it really, unfortunately, reveals itself in practice. When I was just starting this work 8-9 years ago, almost 10 years ago, I guess, my first couple of years, the predominant work I was doing was meeting with folks who had already met with a CFP as their financial advisor. It might have been 6 or 7 people at the time. And those folks did not have great financial plans, in my view. Now, why do I believe that? They all had very expensive life insurance policies, and they had investments that were complex. The investments weren't terrible. I'd give it a B, but the insurance was an F. So, and what was happening? Because I'm looking at all this, and then, you get on your third one, you think, okay, what is going on? These are all CFPs. Why are they telling all these young people, these are people in their 20s, that they all need this product called whole life insurance? It's a life insurance product, hence the name, whole life. It saves you your whole life. It's a hybrid product. It's kind of an investment product. It's kind of an insurance product. But all of them had it, and one didn't. And so great, you didn't have it. Why don't you have it? Well, they're trying to sell it to me. I'm not sure. My concern is, and what I wish the CFP would do, certified financial planners would do, is prohibit the selling of financial products on commission. Because this invariably happens where you get in a room, and if the financial advisor makes 10 times what they would make selling term life insurance is what they'd sell whole life insurance, Wouldn't you know it, everybody and their brother is being pitched whole life insurance. Everybody. And it really takes away from that objectivity that you want when you're meeting with a financial advisor. The analogy I'll use with people, because I get pushback on this, like, what? People have been making commissions forever. Robert, you just need to disclose the commissions. Well, my experience in practice was that I bet they were disclosed, but none of the people I worked for had a clue what the fee was. So in the trenches, it just, either it's told and they miss it. So if you get in a room with someone and they're compensated 10x for selling one product and X for another, you better believe which products come in your way. My suggestion is you should not be selling products on commission. It is a conflict. As the great Charlie Munger said, if you show me the incentive, I'll show you the outcome. So if you smart people, CFP is excellent education, and it's a good designation. I also believe that it's a good designation. You should be delighted when you see someone with a CFP. Just buyer beware. Their standards for selling products are not great. They're not great, and it would move the ball forward a lot if they would change that. So I tell people who push back on this, I say, well, if you go into the doctor's office and you find out the doctor gets paid a commission, depending on which medicine or procedure he suggests, would you be comfortable with that? And most people say no. You would not be comfortable with that. That would be a bad incentive structure, right? If the doctor, if he sends you to the surgery center, he gets $20,000, but if he just gives you some Advil, he gets no money. Is that really a world you want to live in? No. In the investing world with financial advisors, if you have people on commission, and these are wonderful people, by the way, these are some of the finest people I've met. It's not an indictment on them. It's the system that they operate under, and the system wins. So all you can control is yourself. If you're a consumer, you're looking to receive financial advice, you're looking to buy a financial product, ensure that when you receive financial advice, it is as objective an environment as possible. No environment's perfect. Even the beloved hourly people, there are problems with it. I'm an hourly person. We have problems. People want to rush you through a solution. They'll think that there's a potential that you'll spend more time on a project so you can charge more. I mean, nothing's perfect. Nothing's a lie. You do the best you can within the environment. But beware as a consumer. If someone is getting paid to promote a product, think about that doctor analogy. Do you want to walk in the doctor's office and have 10x the commission go to your doctor for one procedure and X for another? You don't want to do it. And in the Wall Street Journal article, how the AI boom has transformed the chip industry into a market monster. This is by Jeong Song and Andrew Barnett. This is Seoul, South Korea. Annyeonghaseyo to my Korean listeners. This caught my eye because I think we have a tendency as investors to overestimate our ability to see the future. Even the most humble amongst us is tempted. Hindsight's 2020. Once NVIDIA becomes as valuable as they kind of saw it, didn't we? This article says 3 years ago, just 3 semiconductor companies cracked the list of the world's 25 most valuable firms. Then the artificial intelligence boom supercharged the industry. Now, 7 companies in the semiconductor world populate the top 25 list. NVIDIA sits at number 1 with a market cap, that's the total value of the company, of nearly $4.3 trillion as of Wednesday, up from $661 billion 3 years ago, 106. Check this out. Worldwide chip revenues are projected to grow 33% this year. That's bananas, and top 1 trillion, according to market research firm Gartner. A lot of the forecasters used to think it wouldn't be hit till 2030. So here we go. They list all these companies, some United States, some international. SK Hynix of South Korea, they're going to do a U.S. listing later this year. It looks like they say their stock price has grown nearly 5-fold since the start of 2025. It now ranks 21 on the list of market cap of roughly $470 billion. 3 years ago, it was only 322 with a market cap of $49 billion. Taiwan Semiconductor Manufacturing, known as TSMC, is a big one. And Samsung, memory chip, they rank 9 and 14 today. That's how big these things have gotten. Why do I mention this to you? Why did this article just pop when I read it? This is why it's so important to index. It's because we're ignorant about the future. The danger and I've seen it, if you bought an actively managed mutual fund, or increasingly if you just were at a money manager who picked stocks for you, but they were in your brokerage account, not a mutual fund, but they were charging you, an assets under management fee to pick. And if they missed this, meaning they didn't see the chip industry just taking off like this, it's not just a aw shucks deal. It's you're going to lag the index for a decade or more. So it is so hard. It is so hard to predict these things. And right now, it kind of seems obvious, doesn't it? Who didn't see the AI boom? Who didn't see the chip boom? I didn't. And the market told you they didn't either. The world didn't. Otherwise, NVIDIA would have been worth a whole lot more 3 years ago or 10 years ago or 20 years ago. So because this surprised everybody, if you indexed, you owned it all. Remember or the detractors would say, oh, you're just going to get marginal results. You're going to own everything. How could you do that? In fact, we circle back to the CFP and what's the language they use? They said, rigid indexing can lead to forced trades, unnecessary turnover, and missed opportunities. This is the CFP session I printed. In this session, we'll explore what it looks like if you were to open with a blank slate approach rather than fitting investments into a predefined box. We ask, what insights can we trust? What strategies have stood the test of time? How do we balance cost, benefit, and complexities in portfolio construction? So they're setting you up to say, some active, some passive is the best thing for you, which just another way of saying more decisions for you, the investor, to have to make because you have to rotate in and out of active managers. Back to our chip. This is, in my view, why simple indexing and simple global indexing, because you notice the South Korean firm took off, simple global indexing is the best for you. It ensures that you are not caught when any sort of nascent industry just takes off. Chase it. Because what do you do now? Let's say you're with a money manager at Goldman Sachs, Merrill Lynch, whatever, and they had 20 to 25 stocks that they thought were best. And let's say they missed the chip boom, missed NVIDIA, missed these companies. The index has these in them. So the index is going to receive the tailwind of having these folks as members in the index. If you don't, you're behind. And when do you jump off that train? I've seen it. It's very difficult to call this shot. Okay, well, what do I do? Is this a fad? Is this a bubble? That's people tell you now, AI is a bubble, chips are a bubble. I don't know. But if you're indexed or if you're thinking about it, this is another reason to do it. We just don't have a clue. There will be another industry like chips that takes off that we don't see coming. And to ensure you don't get left behind, own it all. Don't try to find the needle in the haystack. Own the whole haystack. And then I had a really helpful friend of the show send me, I haven't finished the podcast, but there's a podcast sent out called My First Million. And it had a great intro that I found compelling, warning about the S&P 500 and essentially buying the American index, what that will do to investors. And it had Howard Marks, who's well thought of, respected investor with Oak Tree Capital, giving his synopsis on why it could be so dangerous. And I went back and looked at his predictions, and he's been saying this for a while. So he talked about these price to earnings ratios. So this is a year ago he said this. Based on historical data, the current price to earnings ratio of the S&P 500, it's around 21, this is a year ago, has offered returns over 10 years between negative 2% and 2% a year. So that's, by the way, that's the correct data. So Howard Marks is giving us correct data. He says the yield on the 10-year treasury is 4.38. It's higher than your earnings yield. Therefore, look, it's a sucker's bet. These are my words, not his, but he's basically saying, why would you buy the index with this visibility into what's happened historically? What's the answer, listener? I want you to think about it, because I think it's most difficult to stick to the tried and true when thoughtful, intelligent investors are offering us warnings. And I'd say in this podcast also, they gave one of their solutions was just buy Berkshire Hathaway for the next 10 years. Don't buy the S&P 500 based on this data. Well, I went back. This is how hard it is to hit these strategies. I went back and I looked. I said, about a year ago when this, I did 1 year from today. Where was the S&P 500 versus today? Well, it's up, even with the market correction, it's up 14.2% from when Mark said that the S&P 500 was uninvestable. He still may be right. But you see how hard that is? Let's say you took him at his word a year ago that, and it's not his word, by the way. This is Howard Marks telling us the data, which is correct data, by the way. He's not making this up. But he's saying, hey, at this PE ratio, this price earnings ratio for the S&P 500, historically, if returns are in the future what they were in the past, you're about going to be flat, -2 to 2% a year for the next decade. Well, guess what? If we're 1 year into his prediction, and I don't know if I didn't check, I don't know if he made this prediction earlier, but you're up 14%. Okay. Well, I thought that the data showed -2 and 2%. Wow, 14% is above that. Welcome to investing. If you or I were able to tell, if I knew for certain that Berkshire Hathaway would outperform the S&P 500 over the next 10 years, I'd do it. I'd be the first on the pod. We'd lower the flags to half mast, and I'd say, all right, no more indexing. Going with Berkshire. The price to earnings multiple is too high. It's too high on the index. I think it's a very dangerous game when people elect to go to cash. Because let's say you've done it. Hey, you go to cash. Market's up 14. And by the way, it was up more than that. I mean, it was up 26% at one point. So it's had a retracement since the Iran conflict. But what were you going to do? You're going to sit in cash? This is like the 1996 to 1999 deal. In 1996, everybody said the market was overheated. It did 30% per year for the next 3 years, something like that. Now, they were right eventually. But I do not like myself to get in this game because I have no idea whether the future will rhyme with the past. That's something to consider. There's no rule that says -2 and 2% is what it'll return in the future. It's just what's happened in the past. It's quite possible that an elevated price to earnings ratio this time is different. How would it happen? Earnings would accelerate. Believe it or not, the market, which sees it all, incorporates it all, no secrets in the market, it knows this data and it's saying, oh, yeah, we see this. We know the market knows the data and it's buying anyway. So collective wisdom, which I know it doesn't always feel like that, of the stock market, all the available participants voting with their money are saying, yeah, we see your data, Howard Marks, and we're still buying. So let's control what we can. Let's be very careful not to go in and out on this deal. And you know what that is, listener. Let's keep our costs low, investing simple, and time horizon long, because that is what's going to give you the best shot on your investing journey. Until next week.